Welcome to a deep dive into the world of high-yield enticing prospect, a steady income stream, and series of high-yield dividend ETFs. 20 minutes, we'll navigate the often complex terrain of these financial instruments. We aim to demystify the concept of high-yield dividend ETFs, explain how they function, and discuss their potential rewards and risks. Understanding high-yield dividend ETFs is crucial for anyone considering this investment strategy. They offer an enticing prospect, a steady income stream, and the potential for significant returns. But, like any investment, they come with their own set of risks. We'll also take a closer look at some specific examples of high-yield dividend ETFs, PFF, IDV, JANK, PCF, MORT, and SDIV. By the end of this video, you should have a solid understanding of whether these ETFs are a good fit for your investment portfolio. Stay with us as we uncover the mysteries of high-yield dividend ETFs. Hey there, viewers! If you're loving the content you're watching right now, don't miss out on all the upcoming videos packed with fresh tips, tricks, and inspiration. Hit that subscribe button so you can stay updated and be the first to know when we post new content. And don't forget to leave a comment and share with your friends. First off, let's unpack what we mean by high-yield. High-yield dividend ETFs, then, are investors. Well, the primary appeal of high-yield dividend decline, but it's not all about risk. High-yield income to investors through investing in stocks that pay high dividends. Now, let's break down that definition a bit. ETFs, if you're not familiar, are funds that trade on an exchange just like a stock. They hold assets such as stocks, bonds, or commodities, and are designed to track the performance of a specific index. High-yield dividend ETFs, then, are a specific type of ETF that focus on stocks that pay high dividends. Dividends are a portion of a company's earnings that are paid out to shareholders. A high-yield dividend ETF invests in a variety of these dividend-paying stocks with the goal of generating a steady income stream for investors. The high-yield part of the name comes from the fact that these ETFs specifically target stocks that pay higher than average dividends. So, what does this mean for investors? Well, the primary appeal of high-yield dividend ETFs is the potential for income. By investing in these ETFs, investors can potentially earn a steady stream of income in the form of dividends. This can be particularly appealing to those looking for regular income, such as retirees. However, it's important to note that the high yield of these ETFs also comes with a higher level of risk. These risks can include market volatility, the potential for dividend cuts, and the risk that the stock's price will decline. But it's not all about risk. High-yield dividend ETFs also provide the benefit of diversification. Since these ETFs invest in a variety of stocks, they can help to spread out risk and potentially smooth out returns. Knowing what they are is just the first step. Next, we'll delve into how they work. Now, understanding how high-yield dividend ETFs to include in the ETF. To do this, this gives ETFs a level of flexibility that weight with the stock market. And there's always the chance that stocks that pay high dividends. They're designed to provide investors with a steady income stream, typically much higher than what you'd get from a regular savings account or a typical bond. These ETFs are managed by professionals known as fund managers. Their job is to pick a collection of high-dividend stocks to include in the ETF. To do this, they use a variety of strategies, including analyzing company financials and market trends. They'll often focus on mature companies and established industries, as these companies are more likely to pay consistent dividends. But how does one go about buying and selling these ETFs? Well, it's pretty straightforward. Like individual stocks, ETFs are traded on major stock exchanges. You can buy and sell them throughout the trading day at market price, just like you would with any other publicly traded stock. This gives ETFs a level of flexibility that traditional mutual funds lack. Once you've bought shares in a high-yield dividend ETF, you'll start receiving dividends. These are typically paid out on a regular basis, often quarterly. The amount you receive will depend on the total dividends paid by the stocks in the ETF, minus any fees charged by the fund manager. Now, it's important to remember that while high-yield dividend ETFs can provide a steady stream of income, they're not without risks. The value of the ETF can fluctuate with the stock market, and there's always the chance that the companies in the ETF could cut their dividends. That's why it's crucial to do your research and consider your risk tolerance before investing. But if you're looking for a way to generate income from your investments and you're willing to take on a bit more risk, high-yield dividend ETFs could be a good option. They might seem complicated, but once you get the hang of it, it's a powerful tool in your investment arsenal. Let's move on to some real-life examples of high-yield International Select Dividend ETF, or IDV, bonds from various sectors and industries. It's a sizable. This ETF targets an index of mortgage REI. Now remember, high yield often means high risk. Equities, high yield bonds, closed-end fund ETFs. It's a colossal fund with billions of dollars in assets. The yield is typically around 5 to 6%. Next, let's talk about the iShares International Select Dividend ETF, or IDV. This ETF is designed to measure the performance of an index made up of high dividend-yielding equities in non-US developed markets. Essentially, it gives investors access to international companies that pay high dividends. The yield varies, but often hovers around the 6% mark. Then there's the Spider Bloomberg Barclays High Yield Bond ETF, or JNK. This ETF targets the Bloomberg Barclays High Yield Very Liquid Index, which includes high-yield corporate bonds from various sectors and industries. It's a sizable fund, with billions under management. The yield is typically around 5%, although it can fluctuate. Let's now move to the Invesco CF Income Composite ETF, ticker PCF. This fund is a bit different. It's an ETF of closed-end funds, specifically targeting income-oriented closed-end funds. The yield tends to be higher than many other ETFs, often in the 7 to 8% range. The next on our list is the VanEck Vectors Mortgage REIT Income ETF, MORT. This ETF targets an index of mortgage REITs, companies that invest in mortgage-backed securities. It's a smaller fund with assets in the hundreds of millions. The yield is typically high, often in the 10% range, but it comes with higher risk. Last but not least, we have the Global X Super Dividend ETF, or SDIV. This ETF targets the Selective Global Super Dividend Index, which includes 100 of the highest dividend-yielding equities worldwide. The yield is typically high, often in the 8% range. Now remember, high yield often means high risk. These ETFs can offer attractive income streams, but they also come with potential pitfalls. It's crucial to understand the risks associated with each ETF and to diversify your portfolio accordingly. In summary, we've covered 6 high-yield dividend ETFs: PFF, IDV, JNK, PCF, MORT, and SDIV. Each offers a unique approach to income generation, from preferred stocks to international equities, high-yield bonds, closed-end funds, mortgage REITs, and global dividends. The yields range from around 5% to 10%, offering potential for substantial income. But as always, it's important to do your own research and consult with a financial advisor before making any investment decisions. These are just a few examples of the many high-yield dividend ETFs available, each with its own benefits and risks. These examples give you a glimpse into the variety and potential of high-yield dividend ETFs. However, like any investment, high-yield dividend ETF, with your investment value skyrocketing, but remember them to shareholders. Either way, when a company can be sensitive to changes in interest rates. It's a bit like sailing on the open sea. It's essential to weigh these risks against the potential reward. This means that the value of these ETFs can fluctuate, sometimes significantly, in response to changes in the market. Imagine a roller coaster ride. On some days, the market might take you on a thrilling climb, with your investment value skyrocketing, but remember, what goes up must come down. The market can just as easily plunge into a terrifying descent, causing your investment to lose value. The key is to buckle up and be prepared for this ride. Next, we have the risk of dividend cuts. Companies can decide to reduce or even eliminate their dividends. This can happen for a variety of reasons. Maybe the company is facing financial difficulties, or perhaps it wants to reinvest its profits back into the business rather than distributing them to shareholders. Either way, when a company cuts its dividend, it can impact the yield of your ETF and consequently your potential income. And then there's the potential for losses. We're not just talking about a temporary dip in the market. Sometimes companies can go under, and when that happens, shareholders can be left holding the bag. In the worst-case scenario, you could lose your entire investment. Let's not forget about interest rate risk. High-yield dividend ETFs often contain bonds, which can be sensitive to changes in interest rates. When interest rates rise, bond prices typically fall, and vice versa. This means that if you're holding a high-yield dividend ETF that contains bonds and interest rates rise, the value of your ETF could decrease. Lastly, there's credit risk. This is the risk that a company or government that issued a bond will fail to pay back its debt. If this happens, it can lead to a decrease in the value of your ETF. As you can see, investing in high-yield dividend ETFs is not without its dangers. It's a bit like sailing on the open sea. On a good day, the sun is shining, the sea is calm, and everything is smooth sailing. But at any moment, a storm could hit, turning your peaceful journey into a tempestuous ordeal. But don't let this deter you. Remember, every investment carries risk. The key is to understand these risks, plan for them, and balance them against the potential rewards. Only then can you make an informed decision about whether high-yield dividend ETFs are right for you. It's essential to weigh these risks against the potential rewards. On the flip side, high-yield dividend ETF be a significant advantage. It's like having a partner companies. This can help you to reduce risk within the ETF increase. It's like buying a company who can stomach the risks and are looking for a higher substantial rewards, but they also come with their own set of and substantial stream of income. This happens because these ETFs focus on companies that pay out a larger portion of their profits in dividends. So if you're an investor seeking a steady income, this can be a significant advantage. It's like having a part-time job that keeps paying you even when you're not working. But remember, the amount you receive can fluctuate based on the profits of the companies within the ETF. The second reward lies in the power of diversification. High-yield dividend ETFs can be an excellent tool for diversifying your investment portfolio. Instead of putting all your eggs in one basket by investing in a single stock, ETFs allow you to spread your investment across multiple companies. This can help you to reduce risk and increase the potential for returns. It's like having a well-balanced diet. It may not be as exciting as eating ice cream for every meal, but it's much healthier in the long run. The third potential reward is the opportunity for capital appreciation. While the primary focus of high-yield dividend ETFs is to generate income through dividends, there's also a chance for the value of your investment to grow over time. This happens when the market prices of the companies within the ETF increase. It's like buying a classic car at a reasonable price and then seeing its value skyrocket over the years. However, it's important to note that these rewards don't come without risks. High-yield dividend ETFs often focus on companies with higher risk profiles, meaning they may be more susceptible to market volatility and economic downturns. It's essential to consider your risk tolerance and investment goals before diving into these types of investments. But if you're someone who can stomach the risks and are looking for a higher potential return, high-yield dividend ETFs can be a worthwhile addition to your portfolio. They offer a unique combination of steady income, diversification, and potential for capital appreciation that can be hard to find in other types of investments. In the world of investing, there's no such thing as a free lunch. Every investment comes with a unique set of risks and rewards. High-yield dividend ETFs are no different. They can offer substantial rewards, but they also come with their own set of risks. It's all about finding the right balance for your investment portfolio. The potential rewards can be enticing, but it's crucial to balance them against the risks. In the end, the decision to invest in high-yield dividend ETFs should be made based on a comprehensive understanding of both the potential rewards and the inherent risks. So, are high-yield dividend ETFs worth the ETF, MORT, and SDIV, each with its own steady income stream, the potential for capital oppose, or they might be newcomers looking to dip their toe? Rather, it's a decision that is as unique as each investor. Let's take a step back and take another look at what we've covered. We've seen how high-yield dividend ETFs work, using the power of diversification to spread risk across a wide array of investments. We've delved into examples such as PFF, IDV, JNK, PCF, MORT, and SDIV, each with its own unique portfolio and dividend yield. We've also talked about the risks, the potential for market volatility, the chance of companies reducing or eliminating their dividends, and the overall higher risk profile compared to more conservative investment options. But with greater risk often comes the potential for greater reward, and that's where the appeal of high-yield dividend ETFs comes in. The rewards, as we've discussed, can be significant. The possibility of a steady income stream, the potential for capital appreciation, and the opportunity to reinvest those dividends to compound your earnings. It's these rewards that can make high-yield dividend ETFs an attractive option for certain investors. So who are these investors? They might be individuals who are comfortable with a higher level of risk, those seeking to diversify their portfolio, or perhaps those looking for a potential income stream. They might be seasoned investors who understand the market's ebbs and flows, or they might be newcomers looking to dip their toes into the world of high-risk, high-reward investing. Ultimately, whether high-yield dividend ETFs are worth the risk depends on your individual investment goals and risk tolerance. It's a decision that requires careful consideration, thorough research, and perhaps a bit of soul-searching, but for those who are willing to weather the storm, the potential rewards may just make the journey worthwhile. And that, dear viewers, is a crash course on high yield, then delved into the mechanics of these ETFs, opportunity for investors, with its own set of pros and cons of these investments. Finally, we grappled with the defining high-yield dividend ETFs, painting a picture of these funds as baskets of assets that aim to deliver higher-than-average dividends to investors. Remember, these are not your everyday ETFs, but rather, they're specialized instruments designed to satisfy the appetite of investors seeking high income. We then delved into the mechanics of these ETFs, highlighting the fact that they function by investing in a diverse range of dividend-paying companies. We emphasized that these companies often operate in stable, mature industries with established track records of profitability. From there, we ventured into the realm of specifics, examining a handful of high-yield dividend ETFs. We looked at the likes of PFF, IDV, J&K, PCF, MORT, and SDIV. Each of these ETFs was presented as a unique opportunity for investors, with its own set of pros and cons. We didn't shy away from discussing the risks associated with high-yield dividend ETFs. We underscored the fact that while these ETFs can offer attractive returns, they're not without their hazards. Market volatility, interest rate fluctuations, and the potential for companies to cut their dividends were all flagged as potential risks. But, of course, we also celebrated the rewards. The allure of steady income and the potential for capital appreciation were highlighted as the key attractions of these investments. Finally, we grappled with the million-dollar question. Are high-yield dividend ETFs worth the risk? While the answer to this question will vary from investor to investor, we stress the importance of considering one's personal risk tolerance, financial goals, and investment horizon before deciding to invest in these ETFs. If you enjoyed this video and found it helpful, remember to subscribe, like, and share. Until next time, here's to smart investing.